Hello, CMA candidates. This is Nathan, and I'm ready to go over a new video with you. In this video, we'll go over the valuation topic, and you can find this in the CMA Part 2 exam. Okay? New company sales and profits are growing rapidly, and so is its dividend. Its dividend is growing at an annual rate of 25%. This growth in the dividend is expected to continue for 2 years. After that, the rate of growth is expected to slow down to 10% per year. The investor's required rate of return on the stock is 16%. The next annual dividend is expected to be $1. The beta of new company stock is 1.5. The U.S. Treasury bill rate is 4%. So the question is, what is the risk premium of the market? There's a lot of numbers thrown at you on this question, and to get to the answer, the best way and the best formula to use for this case, in this case, is the capital asset pricing model, or CAPM for short. Okay, and that will be the first step in answering this question. And what we have to do is calculate the expected return to the market. Okay, so let's write down the formula for CAPM, or for capital asset pricing model. So the formula is R, and that is where cost of retained earnings based upon investors' required rate of return is equal to RF, and that is the risk-free rate of return, plus the beta coefficient, and then we open parentheses, and we have the market rate of return, which is RM, minus the risk-free rate of return, which is RF, and we close parentheses. By looking at this, all the required information for the model, except the market rate of return, is given in the problem. Okay, since we have only one unknown, which is the RM, the market rate of return, we can solve for this equation by plugging the numbers into the formula. Okay, so let's get started. So we start with the cost of retained earnings, or the investor's required rate of return, and that's given to us, and that is 16%. So let's write down 16%. Is equal to, and the next one is the risk-free rate of return, or RF. And that normally is the U.S. Treasury bill, and that's 4%. Okay, plus, and then we'll look at the beta coefficient, and that is given to us as well. It says that the beta of the new company stock is 1.5. So we just have to plug that in, 1.5. Now we're going to open parentheses, and we're looking for the market rate of return, RM. So that's the one we're trying to solve for. So we just write RM minus the risk-free rate of return, and that we know is 4% from the U.S. Treasury bill. Now all we got to do is solve for the market rate of return, RM. Okay, so if we start doing that and go through and do the math, you will find that the market rate of return is 12%. Okay, or 0.12. Both are the same thing. Now, to calculate the market risk premium, we have to take the following formula, which is the market rate of return minus the risk-free rate of return. And because now we know that the market rate of return is 12%, and we've always known that the risk-free rate of return is 4% based on the U.S. Treasury bill, the market risk premium is equal to 8%. And that's the final answer. So the answer is C. Okay? So always pay attention to the information that is given to you. Not everything is applicable to solving for the answer. For example, we were told that the annual rate of dividend is 25%, right? The growth. And it's expected to continue for 2 years. We didn't need that information to solve the problem. Okay? And then the rate of growth is expected to slow down to 10% per year. Again, we did not need that. And the next annual dividend is expected to be $1. Again, that's irrelevant. So pay close attention to the information that you actually need on the exam, and the best way to do that is by knowing your formulas by heart. If you know the formula by heart and you know when to apply it, it's a matter of writing it down, plugging in the numbers, and solving for whatever it is that you don't have the information for. Okay? I'll talk to you guys in the next video.